Yesterday in the stock market, we saw Nvidia down 3.5%, what felt like the first time in a long time. And today as well, in the pre-market, it is down another 2%. Now, whether or not we do get a stock market crash, today's episode we are focusing on 4 high quality companies that we will be adding to in the next significant market dip. We're going to run through each one of these high quality companies, what we love about them. We're going to take a look at their dividend safety, as well as looking at their underlying metrics like their free cash flow growth, ROIC, talking about some metrics we really like about these companies. And as always, we're going to run every single one in the valuation model, getting to our intrinsic value, our acceptable buy price, so you can understand the price targets we have, whilst incorporating a margin of safety, as well as looking at Wall Street to see what they are forecasting over the next 12 months. So the first high quality company we will be buying is Visa. Now currently in the market we do get a double buy rating with a hold from Quant. It is trading right there towards its upper end of the 52-week range with a forward yield of 0.76% and a forward P of just under 28. Bear in mind, S&P right now is 22.5, and over the last 12 months, it has been up around 22%. Over the last 10 years, not just very strong, up 425%, but it has also historically outperformed the S&P 500. Now, in terms of dividend safety, no surprises, 99 very safe. That is in fact the highest score obtainable. Market cap 554 billion. It is a mega cap company, and we can in fact see just last month the dividend rating was reaffirmed, so a dividend cut does look to be highly unlikely. Now, in terms of the last recession, the Great Recession 07-09, they did increase the dividend, plus they had plus 10% recession sales, which was well above the average of the S&P, which did come in at around negative 12. Now, in terms of their dividend growth, so one of the things we love, double-digit increase last year, double-digit increase over the last 5 years, and over the last 10 years, on average, they have increased those dividends by 18%. Now, they have also been paying a consecutive increase to the dividend year on year for the last 15 years. In terms of dividend yield theory, now for those that are new to the channel, it does state a company is undervalued when the current yield sits above the 5-year average. So for Visa, we actually do get an undervaluation signal. We get a double undervaluation given the forward P 26.5 does sit lower than the 5-year average of 29. Although bear in mind, financial sector does sit much lower at 11.1, but as always, it could be justified that this deserves to have that higher P depending on the underlying metrics that we will run through. But also do bear in mind, we're not looking at any of these models in isolation. We will conclude towards the end. So free cash flow payout, as always, over the earnings, which is susceptible to manipulation by management through accounting. Below 60%. Reason for this target that we have, it does give us faith that like Visa have been doing, they will be able to offer those double-digit increases. And pretty much over the last 10 years, it's near enough below 20%, 19 in 2023, 20% expected into 2024. In terms of the free cash flow per share, well, again, with this metric, we want to see consistent increases over the longer term. That is what we get with Visa over the long term. In fact, they have increased it by around 3 times, expected to continue that uptrend over the next 12 months as well. In terms of sales growth, well, double digit is what we expect from Visa given how strong that's been, and pretty much what we do get year on year. For other more mature companies, we do look at a steady 3 to 7% growth. With Visa, 11% in the more recent year, 10% on a trailing 12-month basis. In terms of numericals, well, they've pretty much nearly tripled their top line over the last 10 years. And on top of that, they do return excess cash. They do share buybacks quite consistently year on year, which is always great to see. They have bought back around 460 million shares over the last 10 years. ROIC then, as always, an incredibly important metric. We want to see here 10% as a minimum, just to give us faith management are able to effectively allocate their capital. They've been doing very strongly, double digit, in fact, increasing over the longer term, 34% in the more recent year. As always, these metrics that high do make it incredibly attractive to potential investors. Operating margin were one of the best that we have ever seen. Above 12% is what we want to see, and they're consistently well above that into the mid-60s year on year. The same tune to be said for the free cash flow margin, significantly strong, in fact in the low 60s over the last 3 years. This is potentially one of the best free cash flow machines that you could have in your portfolio. Net debt to EBITDA, so the earnings before interest, tax, depreciation, amortization, tells us a story in 2 parts. 1, essentially the strength of the balance sheet. 2, essentially showing us the dividend safety. 0.05. Now what this represents is the number of years it would take the company to pay off all of that debt net of cash on hand, showing us it would barely take them a few days at the most. Phenomenal balance sheet. Dividend safety score 99, understandable, and over the next 12 months a very marginal increase, so no issues there whatsoever. Now let's jump into the valuation model. As always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you're continually notified of these videos. And typically on this channel we do run through every single one of these models. Today we're going to jump straight into the intrinsic value final calculation, and it is coming to $321. Now current price around $276. We always start off with a margin of safety of 10%, and we execute on that only if it meets our 3 golden criteria: a wide moat, strong financial metrics, good forward-looking data. If you agree, well, in today's episode it would be a buy up to 288. Then we keep going to show us what MOS level we're working with. It isn't at a 15% just yet, and in today's episode we would like to add this. It is a very high quality company, and around a 20% margin of safety at $256 does look incredibly attractive, and who knows whether or not in the shorter term we will see this price action. So right now then, as we mentioned, 10 to 15% MOS level. In terms of Wall Street and their forecast, well, they do see upside of 15%. Their price target not too far off our intrinsic value, $318. As always though, as we do go through along these stocks, do let us know your thoughts in the comments below. Now before we do move on to the next one, just to let you know, we have released our latest free weekly article. If you want access to this or any other articles all completely free, do click on that pinned comment below. For example, if you want to see the websites and screeners we use, this article here does lay them all out. Or if you want to see our latest 12 undervalued high quality dividend stocks, again, this article will run through them in detail. The next one we're looking to add is Microsoft. Now we do have a hold rating, a strong buy from Wall Street and a buy from Seeking Alpha. It is trading right there towards its 52-week highs. In terms of forward yield, well, 0.67%. In terms of forward P, just under 38. And we can see over the last 12 months, phenomenal performance, up 32%. And if you're a longer term shareholder, you would be up 956%. And again, if you do reinvest those dividends, it would be up, although marginally higher. And this is again similar to Visa, outperform the S&P. No surprises then, another very safe 99 score, market cap 3.31 trillion, a mega cap company, and again reaffirmed just last month, dividend cut for Microsoft looking highly unlikely. Now in terms of the last recession, well, they did maintain the dividend, they didn't increase it or cut it. They had average growth -9%, and they marginally outperformed with their -48% return. Consistency is what you do get with that dividend. 10% increase last year, 10% on average over the last 5 years. Over the last 20, looking very strong at 19%, and we can see they have been increasing those dividends for the last 13 years. No surprises then on dividend yield theory. We do get the overvaluation signal on both the yield as well as the forward P, and we can see it is trading significantly higher than the information technology at 27.3. Now in terms of the free cash flow payout, well, it is significantly lower than 60%. 32% anticipated over the next 12 months. In terms of the free cash flow per share, well, more than doubled over the last 10 years. And again, that upward trend is expected to continue into the full year of 2024. Sales growth will double digit nearly every single year, although we do see that drop in the more recent year. 2024 expected to be another strong double-digit year for MSFT. In terms of their top line, well, as we can clearly see, more than doubled over the longer term, and very similar to Visa, they do return that excess cash. As we can see, year on year, they are doing those share buybacks, although we do note that recently in this few quarters, we are waiting to see whether or not they will execute on more. In terms of the ROIC, well, very strong, increasing over the longer term, and again, showing some very similar numbers to Visa in the low 30s. This is what we really like to see from any company we are considering investing in. In terms of margins, well, very strong. This is what we call operating efficiency, where the margin does increase over the longer term, and a trend we do like on this channel, increasing revenues as well as increasing margins. Free cash flow, again, another very solid free cash flow machine to consider for the portfolio. In terms of the net debt to EBITDA, well, phenomenal over the last 10 years, and in 2023, not even one day for them to pay off all of that debt net of cash on hand. They do have one of the best balance sheets globally, in line with Johnson & Johnson as well, and we can see it is expected to increase, although marginally over the next 12 months, which has no real repercussions essentially in terms of that dividend safety or balance sheet strength. So in terms of valuation, let's get to it. Don't forget you can grab a copy of this model by clicking clicking on the pinned comment below, getting to both intrinsic value and acceptable buy price of companies in your own portfolio. Now, with Microsoft, unlike with Visa where we did see some MOS, we do believe it is currently trading marginally higher than its intrinsic value. So if we were to put an MOS of 10%, we can see an acceptable buy would be around $385. Now, we do quite like Microsoft. It is one that we do hold within our portfolio, but right now at the current trading price with no margin of safety, this isn't one we are looking to add. At a bare minimum, we would consider it around a 10 to 15% margin of safety, so between the $360 to $380 mark. As always though, do let us know your thoughts in the comments below. And in terms of Wall Street, while they do see upside, they believe Microsoft is heading for around $500 per share, and as we can see, they believe 12% implied upside over the next 12 months. We then move on to ASML holding. Now we do have a double buy from Seeking Alpha Wall Street, a hold from Quant, again similar to MSFT, trading right there towards its 52-week high. A forward yield 0.71%. Forward P very high at 51, and over the last year it has been going up very strong, 46%. Over the last 10 years, up more than 1,000%. So in fact, over the last 10 years, it has outperformed both Visa and Microsoft, as well as the S&P. In terms of dividend safety, well, a score of 82, so very safe. Market cap, 417 billion, a mega cap company. And we can see the 1st of May, it was reiterated. Dividend cut looking highly unlikely. Well, last recession, do take note, they did cut the dividend during the Great Recession. They did have below average by significantly negative 56%, and they pretty much came in bang on S&P negative 55% return. One thing I do love about this company is their historical dividend growth. Although last July they did increase it mediocrely at 5.8%. This means we are anticipating an increase over the next few weeks. 24% on average year on year over the last 5 years, 26 over the last 10, and we can see they have been increasing those dividends for the last 14 years. Now, in terms of dividend yield theory, we do actually have an undervaluation signal on the yield. On the forward P, though, it is trading significantly higher than the 5-year of 33.9, and we can also see information technology sits much, much lower. In terms of the free cash flow payout, well, for semiconductors, when we do go industry specific, below 50%, which has been completely fine other than 2023, probably why we did see that mediocre dividend increase. Nice to note, over the next 12 months, anticipated to come right down to 21%. Free cash flow per share, with a little bit of inconsistency. Granted, it has increased over the longer term, but what is very nice to note, that increase upward trend is expected to continue over the next 12 months. In terms of sales growth, 3 to 7%, as we said, as a baseline. What they do have here is pretty much double digit nearly every single year. 30% just in that more recent year of 2023. In terms of sales, were absolutely phenomenal, pretty much 5 times their top line over the last 10 years, whilst also doing some share buybacks year on year, although fairly trivial in the grand scheme of things for this company. ROIC, well, above that 12% that we want to see for semiconductors. Over the last 3 years, touching that nearly 50% level, very, very strong, especially if they can stick with this consistency. In terms of operating margin then, above the 16%, again operating efficiency over the longer term, up to 33% in 2023, and we can see their free cash flow margin, while very inconsistent, we see some phenomenal years over the last 2, and even 12% in 2023 is still a very strong number for this semiconductor company. On top of that, well, look at that, that is beautiful, not just 0 across the board, but also anticipated over the next 12 months, as well as the trailing 12 month, so incredible balance sheet, and again, no real surprises, that balance sheet as well as dividend do look very strong and secure. In terms of the valuation then for ASML, the intrinsic value is coming to just over $1,000, and very similar to Microsoft, we do believe it is trading right now although at a very small premium. So if you were looking for a margin of safety at 10%, we would be looking around $914, at 15% around $862, which is pretty much where we would look to consider to add this to the portfolio. As we said, right now we do believe this is trading at a very marginal premium. In terms of Wall Street and their forecast over the next 12 months, well, they see very limited growth for ASML, upside of 2%, and their price target $1,069. We then move on to the next company. It is Costco Wholesale Corporation, with a buy from Wall Street, a double hold from the other analysts, again trading at its 52-week high. Forward yield, well, 0.54%. Forward P, again, very high at 53. Over the last year, we're up 70%. Over the last 10 years, 745, and again, significantly outperforming the S&P. In terms of dividend safety, well, the third very safe 99 score in today's episode. Market cap, $382 billion. It is a mega cap company. Now, dividend safety, again, beginning of this year, reiterated highly unlikely dividend cut, and they did in fact increase the dividend during the recession above average growth, and they did also outperform the S&P negative 38% return. Again, another very strong dividend growth company, 14% just this year, 12% on average over the last 5, 13% average over the last 10, and we can see 19 years of consecutive increases. We will also point out that they have done a recent special dividend, which isn't unlike Costco. They do this every few years, and in January this year it was $15 per share. Now, in terms of dividend yield theory, well, we do get an overvaluation signal on both the yield as well as the forward P, which is going much higher than the 5-year rolling of 36, and we do also note consumer staples sits much lower at 18. Now, in terms of the free cash flow payout, well, below 60% is pretty much every single year, 23 in 2024, which is why these companies can offer those very nice dividend increases, pretty much double digit consistently. Free cash flow looking very strong as well. We do notice nearly 4 times growth over the last 10 years, expected to continue again, $20.50 over the next 12 months. In terms of looking at that sales growth, well, what we do notice here, very strong year on year, 7% in the more recent year, and when we do look at it numerically, we can see more than doubled over the last 10 years. One thing they don't do is do those share buybacks. In fact, over the last 10 years, very trivial, but it has increased by around 3 million. We then look at the ROIC, consistently very strong. Just take a note when we are looking at these high quality companies, some of the metrics we're looking for, and you can apply them to when you are looking at your own research, 29% on a trailing 12-month basis. In terms of that operating margin, now what we do notice here, it is one of the lowest we have seen today. We want to see above 12%, but what we note with Costco, it is consistently around this level of 3 to 4%. Nice to note, in fact, it has increased in 2023. One thing with Costco as well, another way they can increase their top line through their model is essentially increasing those membership fees, although they haven't done that in quite some time. In terms of the free cash flow margin, well, it is below what we want to see, around the 2 to 4% year on year. Net debt to EBITDA, though, again, a similar trend with all these companies today. It won't even take them one day to pay off all of that debt net of cash on hand, also expected into 2024. So let's jump into the valuation of Costco, and in today's episode, we are getting to $719. Now, one thing to bear in mind, we will touch upon how we got to this, but the current price is showing significant overvaluation, trading at a very high premium. Now, margin of safety at 10%, we would be looking to add this around $647. Now, it may never get there, which is completely fine. The whole point of doing this analysis is to understand your buy price and be patient. There's no point in essentially buying companies when they are overvalued. But again, that does come down to your investment thesis as well as your strategy. So trading at a significant premium in terms of Wall Street, well, their estimations is that right now it will not grow any higher. $854 is where they see this over the next 12 months, which does show implied downside of around 1%. Now, where we got our intrinsic value of 718 for this company is putting it through the DCF model with the free cash flows year on year, average growth rate of 66%. Now, we have gone for a growth rate of 15% with that discount rate. That gives us to the present value of future free cash flows and terminal value, which we add to the cash, subtract total debt, get the equity value, divide by those shares outstanding, and as we can see, the overvaluation signal. Now, as always, we do run them through 3 different levels, so we have a low, medium, and high moving forwards. If you were someone who believed that even 15% is too high for Costco, at 10% it would be much lower. At 20%, it would be trading much higher with 17% upside. So our calculation for Costco is 15% to the free cash flow, but as always, we do like to be a little bit more conservative on this channel, and you can always grab a copy of this model in the pinned comments below. So intrinsic value, as we said, trading at a significant premium. As always, let us know your thoughts on these 4 companies. We had Visa, Microsoft, ASML, and Costco. If we do see a significant dip, these are the 4 high quality companies we will be looking to add to the portfolio. As always, if you did enjoy today's episode, value was provided. Smash that like button, hit that subscribe and bell button. Let us know your thoughts below. And as always, we'll see you all on the next one.